Hi, I'm Bob Kolb, here today to interview John Marthinsen, who's joining us here at Loyola to talk about the risk management book that he has published recently that's been a big success. John is quite a star, actually. He's a professor at Babson College, where he holds a professorship in economics and international business, and also he holds the Distinguished Chair in Swiss economics. He received his PhD and MA from the University of Connecticut, and he recently published a book, Managing in a Global Economy, Demystifying International Macroeconomics. But his most recent book is Risk Takers, The Uses and Abuses of Financial Derivatives. This is his second edition, which was published in 2009. And it's a very interesting book. I've had both editions. It features accounts of some really spectacular snafus with derivatives, Metalgesellschaft AG, Procter & Gamble versus Bankers Trust, a very interesting case in where Procter & Gamble got taken for a ride, this Fortune 100 company, and then pled that it was naive and defenseless against the wiles of Bankers Trust. A story about Orange County where a single man managed to bankrupt the entire county. Also Barings Bank, where the famous trader Nick Leeson brought down a bank with over 100-year history. But today we want to feature just two of the accounts in John's book, one on long-term capital management, which is quite famous, and then a little more recent one, Amaranth. And these are very interesting kinds of situations because they're similar in scale, as we'll see, but they're very different also. So we'll start out by talking about long-term capital management, a little bit of an account of that, and then about Amaranth, and then we'll talk about both of them in the context of today's adventures in the financial crisis of 2007, 2008, 2009, and we don't know when the story really ends. So John, thank you very much for joining us today. So let me ask you first, how did long-term capital management get its start?
Well, first of all, thank you very much for the invitation to be here today. It's a pleasure, and it's a pleasure to talk about risk takers, uses and abuses of financial derivatives. Long-term capital management is one of the most interesting stories of the last 10 years because it was such a spectacular failure. And the way it got started was it was started by John Meriwether, who had a long history, rather turbulent history in finance, started long-term capital management in 1994 with about half the capital that he wanted, but still a considerable amount, $1.25 billion. And like any good manager, he tried to surround himself with people who were even better than he was. So the principles at long-term capital management read like a who's who in the area of finance. So Robert Merton, for example, and Myron Scholes were principals in this. So not that they did the day-to-day work, but certainly they were involved with the strategy. And the strategy of long-term capital management was to take spread risks, which in finance are basically buying and selling the same instrument or similar instruments and making profit no matter whether the market rises or falls. All that's important is whether there's a difference in the spread.
Right. So here we are. We have a situation where we have Myron Scholes and Robert Merton, two Nobel Prize caliber folks, engaged in this firm. And of course, Scholes is the Scholes of Black-Scholes.
Yes.
Focusing on these kind of arbitrage strategies. That's really why he won the prize. And then that ties in very directly to what you just mentioned about the kind of spread trading. So maybe you could kind of tie those two things together.
Yeah, so here you have the Nobel Prize winner, basically the person who opened up the trading of options to the world, because finally we had a scientific way of valuing them. Now, some would argue that we had this before. But be that as it may, these are just absolutely brilliant individuals who use their econometric and finance knowledge to try to find imperfections in the market. So in the book I mentioned that they were not looking for a needle in a haystack, for example, like a Microsoft. they were looking for a haystack of needles. So they're just looking for small little imperfections in the market where they could buy low and sell high, and as a result of that, make a profit. And typically, these types of trades would be very, very safe. And but what long-term capital management did as well was to leverage itself to a very high level. And this is one of the commonalities with almost all of the financial derivative crises we've had, is that there's been extreme leverage so that any small mistake is amplified many times. And as a result of that, if you make a major mistake when there's a major market movement, then even Nobel Prize winners can be a part of a bankrupt company.
Right.
A company, let's say, a company that needs to be rescued.
There are a lot of those these days. Well, one thing I find is so ironic is that the whole idea behind the Black-Scholes option pricing model is to impose a no arbitrage condition and show how you can maintain that across time by active trading. Yet here in long-term capital management, they're basically trying to employ what they thought were, quote, risk-free arbitrage strategies.
Sure.
And find two assets that really ought to be priced the same in theory, and that will become to be priced the same at a certain point if everything works out. So that's the kind of spread trading they were engaged in, as I understand it.
Exactly. And not only that, but they also used very sophisticated risk measurement, or they thought they used very sophisticated risk measurement techniques like value at risk measurement, and they did do stress testing, and it was a very sophisticated group that used statistics in a very intelligent way to find out when there were these imperfections. So the Black-Scholes formula and other pricing models may give you what they think the price should be, and any time the market's price was different from that, they acted on it, and they were able to just clobber it with all of the capital that they had. So they were leveraged. They had at one time assets of 125 billion. They had capital of only 5 billion. So the ratio, the leverage of this company was incredibly high. So when they saw these opportunities, they just jumped on it. And that was a little bit the problem, was that they had such firepower that when they saw an opportunity, they closed it up. They arbitraged it away in a very, very quickly. This firm actually made the markets more efficient. Right. So there was people always look at the negative side of long-term capital management, but there was a significant positive side as well.
Well, let's focus on one kind of trade that they did, which was really sort of a principal one, and that's kind of a convergence trade in treasuries. Mm-hmm. So maybe you could explain to our audience just why this ought to work and how they set that up for that kind of particular trade.
Well, one example would be on-the-run and off-the-run issues of treasury bills. So when a treasury bill first comes out, it's on the run, and there's a huge liquid market for it, and the prices are very sharp.
Right. So an on-the-run is a recently issued
exactly.
Instrument.
So let's say it's a currently issued, let's say, 5-year note. And let's suppose that it's priced at a certain level, and then 3 years later, this 5-year note is now a 2-year note. So it's old, but let's suppose the Treasury issues a 2-year note that's sharply priced. If there's any difference between the price of the newly issued on-the-run 2-year note and the 5-year note that now only has 2 years to maturity, there's a sure arbitrage by buying one and selling the other.
Right, because the cash flows, the promised cash flows from the Treasury are identical, or more or less identical, and you have the same risk-free nature, the same issuer.
That's right.
So they really ought to be priced the same, yet somehow they're not.
Exactly. And in this day and time today, with the markets so turbulent, 2008, with the markets as turbulent as they are, a lot of people have been seeking shelter in the safest possible investments they can buy. And the US government right now is a risk-free investment because the government borrows in its own currency. It has the constitutional right to print and coin its own currency. So the chances of the US government going bankrupt or defaulting on its debt, I think defaulting is probably the better term, are virtually zero. So if you have two identical government securities with identical maturities, they should be priced the same. And when they're not, then someone like long-term capital management can come in and buy the low price one, sell the high price one, and make an instantaneous or a sure profit on that when the two converge.
Right. So, to make it a little more concrete, let's say one of the two is, let's say the on the run is trading for 1,000 at par, and the off the run, the old one is at, I don't know, 1,005. Mm-hmm. So all you have to do, you don't have to be a genius to do this, is you buy the cheap and sell the high, and then you just wait for them to come to maturity and they'll converge.
Exactly.
Oh, I've got a good idea. What if we did this really big? We did it not just with a lousy $1,000, but if we did it huge. And how did that play out? I think you already sort of mentioned that, but.
Yeah, so that way you make your profits, or you're sure of making profits, but it's just like when you have money lying on the street. And this is basically money lying on the street. When it's so obvious, so visible, so ready, other people are going to do the same thing. And one of long-term capital management's major problems was it could not raise its risk level to the level it wanted to raise it. In fact, about a year before it was rescued, it actually gave investors back their capital. They were irate because by reducing its capital, it was able to increase its risk. It was able to internalize its profits. So anybody who had invested in long-term capital management saw their wealth increase hand over fist. So to be told by the principals, we're giving your money back. Many investors, and these were high-heeled, well-heeled investors, they were incensed about it. Of course, very grateful then eventually when long-term capital management, when its profitability just plummeted.
Right. So here we have this firm, very, very prominent people, Merriweather, Scholes, Merton. Huge positions in the market. It naturally attracted a lot of attention, and there were kind of copycats, which also became a problem for them because they wound up sort of competing for these favored positions. And also, as I understand it, wound up with a situation where more or less all the big players were on the same side of the market.
Yes.
Well, as we wouldn't be talking about this case if it had a happy ending, and you've foreshadowed already that it didn't. So it sounds so perfect. Here you described it as money lying on the street, like any fool could do it, maybe I could do it. But somehow these geniuses didn't quite bring it off. How did things start to become problematic?
Well, there were three effects that I outline in the book, and actually there are two editions of the book. The second edition actually benefited from feedback from some of the principals at long-term capital management. And what happened was they used tools and for example, value at risk. And behind value at risk are certain assumptions. And when those assumptions, like for example, that prices will move continuously, are violated, then there are problems with the measure. Another assumption is that the future will be like the past, and when things happen that are totally unlike the past, then the measures that you use, the statistical measures that you use, become corrupt and less usable. So the first thing that happened to long-term capital management was that there were exogenous changes.
What is exogenous, John?
External. So I'm sorry about that. So an exogenous change would be an external change that was totally outside their control. Like for example, in 1997, there was the Asian tiger crisis. And this had to do with countries that had fixed their currencies to the dollar. The currencies had become highly overvalued. And these countries lost virtually all of their international reserves and eventually had to float their currencies. So this created international turmoil, and long-term capital management was invested internationally. So whenever you have turmoil like this, you have oftentimes a flight to safety. So people who are looking for safe assets invest in currencies like the dollar and the euro And actually at that time there wasn't the euro, but the Swiss franc, for example, or the British pound. So Amaranth had been betting that spreads would get closer together.
I think you mean long-term capital management?
What did I say?
Amaranth.
I meant long-term capital management. Long-term capital management was concerned that had bet that the spreads would get narrower, and as a result of this exogenous, this external calamity in Southeast Asia, the spreads got wider, and they lost money. Then a year later, we had the Russian default on their loans, and as a result of that, we had another bit of turmoil. So what had happened over the years, and thank you for mentioning this, was that long-term capital management was so successful that it breeded imitators, copiers, who basically had the same portfolios as long-term capital management. So when long-term capital management needed liquidity, so did these other firms. And as a result of this, they all began selling highly parallel positions, almost identical positions, together. And this caused the market to fall below where it would have fallen if only one hedge fund had been selling securities. So it's like a fallacy of composition. And that's a segue to what's happening right now.
Right, well, exactly. It's like, what would happen if everybody wanted to sell all the financial firms?
Yeah, so you're seeing exactly what's happening now in 2008, is when everybody wants to delever, when everybody wants to get into safer assets. The problem is that it causes the value of those assets to fall. And it's almost like a paradox of delevering, that the attempt by the market to delever creates a reduction in prices that does not allow anyone to delever.
Right. So here we have this situation where for each dollar of capital they actually possess, they have